I got the question, how do I choose a financial advisor or a financial professional? And the context behind it is I had a business owner friend come up to me knowing that I was in the industry and said, Joel, I am getting so many different messages on LinkedIn from different financial professionals. I don't know what I need, if I need anything at all. They know I'm a business owner, and I just need some guidance on how to choose what would be the right fit. So I'm saying, you know what, I'm gonna make this video, and it might turn into a whole video series, but let's just start off with financial professionals and what is the right fit for me. And the first three resources that came to mind on trying to help to guide that is, first, I had already made a whole video series from the CFA Level 3 curriculum on the career stages and wealth segment that people are in. And what it would broke down is, if you're in this stage, here are tools, resources, and people that might be the right fit to help you at that stage. Obviously, when you're very early in your career and you don't have a lot of wealth, then you're going to have to rely more on scalable tools, because you're not going to have the financial means to hire expensive professionals, lack of a better way to put it. So I thought that could be very helpful to help a person kind of dictate where they can be. Second is just resources that everybody has. So everyone can look in ChatGPT, and from there you can look at what do titles mean, what does designations mean. I'm a CFA, so what does that mean? What kind of education have I gone through? There's other designations. There's CPAs that are financial professionals. There's fractional CFOs. There is CFPs. You have financial advisors, financial associates. You have all these different titles and designations, and you can just start looking to see what outside resources are saying. And a lot of times they're pretty accurate, but if you want me to review how accurate any type of source like ChatGPT is, I'm happy to do so. But just available tools for everybody. And then a tool that I have is called the ACQ AI Advisor or Business Advisory. And it's an AI tool that is from ACQ, is the acquisition.com company. And it's more business driven. So for this individual, I thought it'd be helpful because he's a business owner. And I basically, hey, let's work together. Let's type in your full case. And then let's just see like some of the more advanced financial professionals are going to be the right fit for you. And it did, I thought, a phenomenal job. If someone were to really go through the whole process that it laid out, you would have a very, very strong financial professional. So those are three resources that can be used. And I'm going to dig a little bit deeper into what some of these resources are saying. And hopefully this can be of good guidance for others that are looking and in the same case. Okay, we're going to keep on the topic of how to choose a financial professional. And the question is value of fixing a constraint. So it could be a constraint, it could be a problem, it could be a missed opportunity, all things that maybe would cost you money or are costing your business money. I'm going to stick with the three big areas of finance: wealth, business, and tax. And just to start off with wealth, and this is just some simple examples to put things in perspective on where maybe you are. Let's say someone has $10,000 and they're looking to grow that $10,000 versus someone that's got $1 million and they're going to grow that $1 million. The bigger that you are, not only do you now have access to all different types of investments that can potentially produce higher rate of return, it's just a much, much larger number. So let's just say that you are really diving deep into the investing, and you want to, you know what, I'm going to make an extra % rate of return compared to going into a passive investment or doing using a tool where you're not spending a lot of time on it. So 1%, that's only $100 more you're making on a $10,000 account, where 1% on $1 million account is going to be $10,000. So not only is the $10,000 a lot more, but there's just so many more things you can do with $1 million to make that $10,000 easier. So the constraint or the problem on that $10,000 isn't let's spend more money to try making more money. It's, all right, how do we get this $10,000 to $1 million where now we have that problem? And that's where you want to start really focusing on, maybe get that $1 million point, focusing, okay, let's get better at our wealth to make more money. On the business, this can be pretty common, where I'm going to maybe use a little bit of an extreme example, but you have two businesses. One business's revenue is 1.5 million. Another business's revenue is $1 million. Well, sometimes the 1.5 million, they're not making anything. Nothing goes to the bottom line. And the employees and the owners aren't maybe even happy, and everybody's on edge all the time. Whereas there's $1 million businesses that they might be making $500,000. And from that $1 million, $500,000, it could be even in a similar industry. I've seen people in industries where $1 million there's the owner's compensation of $500,000 can definitely be done. Where 1.5 million and there's nothing left over for the owner and the employees aren't happy. That's where we want to start digging a little bit deeper in the business. Now, those numbers can be a little small. You might, a business analyst is probably going to want more than $1 million, but I just want to illustrate the point that business is about how do you maximize that bottom line, and then how do you grow the top line. And the business strategist needs to have proof and examples on how they can and work with your company and be able to fix some of the things that are causing that bottom line number not to be very good. And the third one, taxes, kind of like the wealth, is let's just say you were $10,000. $10,000 is not a lot of income, so you're going to be at a low tax rate. Let's say you're just at 10% tax rate. Well, $10,000, 10% tax rate, you're only looking at $1,000 of taxes. Not too much. So you're not going to want to pay $30,000 on how to save $1,000 as say if you're paying a high-level professional. On the other case, say you're back to the million and now you're taxed at 30%. Well, that's $300,000. So $300,000, now you're going to start looking like, I got to be looking deeper at my taxes. That's a pretty high number, and I bet you there's some things I can do to be more efficient with my tax strategy, my business strategy, to be able to reduce that $300,000, and it's going to be well worth the money. So that's a way of looking at a starting, or at least a starting way of looking at the value and how big that problem can actually be. All right, I'm going to continue on the choosing a financial professional topic, and I'm going to go through the ACQ AI Business Advisor tool. I thought by far this was the most thorough. If you're looking for step-by-step and being really rigorous on how to choose the right financial professional, I thought this was pretty good resource. So it first divided it up into 3 different financial segments that you want to be looking at. Now keep in mind this was a business owner that put in his case, but the first one was business finance. The second is tax planning, and the third one is wealth. And it divided those 3 segments because it could take 3 people. It could take 1 person. It just depends upon the type of business you have. But there's certainly people that have niches and specialties in each of those 3. I'm going to then now talk a little bit about what are they asking for. Well, there's a couple of things that they want. The software was suggesting that you go through. First, on the business finance, it said, let's look at proof of what they've done with cash flow and sensitivity analysis. So sensitivity analysis might be taking different variables of your business, like your price, your costs, all those things, and show how they've been able to take that data in other companies that are very much like yours to be able to help them make more profit. So it's kind of as simple as that. But they want, like, a lot of everything that they're asking for is have them show proof and cash flow and sensitivity analysis. Someone that maybe is a fractional CFO is going to understand what that is, and they're going to be able to show you, yep, this is the company that we had before. It was like yours, and these are some of the things that we did. Next is on the taxes. It's kind of the same thing, is get proof. If you're working with a CPA firm or someone that specializes in taxes, have them show, like, this is how they've deferred, and this is how they've created deductions within the business to create this ultimate bottom line savings by reducing that tax drag on your business. And then third, on the wealth side of it, is they said have them produce an investment policy statement. So wealth is more on the balance sheet side of things, either personal and business. An investment policy statement is going to basically lay out everything that the investment advisor is doing. And then from there, it should demonstrate this is what we've done with a different company or a different person. And here's how these processes have come to yield good results. And that's getting proof that you've done things for other people or companies in the wealth segment. So these are the 3 big segments that we want to dive deeper into. And those are kind of just the starting points. It was actually probably like an 8-step checklist that they put you through on just continuing getting more proof that they're going to be the right fit. All right, I'm going to continue on the choosing a financial professional, and it's on, again, this kind of the second part of the ACQ AI Business Advisory tool. After it's defined the 3 different types of financial segments between the business, the taxes, and the wealth, it then goes through a 7-step process. And the first step is to find the outcome per the role, meaning what do you want? Let's define, like, this is where I'm at, and then can you do that? What's the outcome we want? After you know the outcome, then get proof, and it says get a proof packet, which basically means show me what you've done for people like me that's going to fulfill that outcome. After you've gathered, there's probably 6 different steps that you want the person to show a proof packet, but then score the proof packet. How close are they to your expectations? Once you've done that, you can then take it a step further and run a live proof session, basically saying, all right, it's awesome that you showed this to me, but let's actually call the person that you did this for, if they're willing, and talk me a little bit through. Give me a testimonial. So live is always going to be better than something that's tailored. 5, after they've met all those criteria, run a paid test, basically saying, all right, I'm going to hire you for the next 2 weeks to a month. This is what this is what I'm going to give you. This is what I want out of you. And from there, we'll determine if this is going to be a good long-term fit or not. 6, try to reverse your risk. That is more like, how do you, rather than just hiring a person and paying them a flat fee, maybe partner with them more, meaning that if this doesn't work out, how am I going to get compensated back? Or you have any type of guarantees? Or is there going to be a reduction in your compensation, or if the value that you bring doesn't actually match the price that I'm paying? And then the 7th is just no red flags. If there are red flags where the person says, I'm not going to do any of these things, then just go on to the next person. So that's the 7-step process, pretty rigorous. And each of these steps we can dive deeper into, but hopefully that's helpful to think about. Here's the things that you want to look at. I'm going to continue on the question on how I choose a financial professional. And the topic today is financial professional expectations. And a lot of what I'm going to be going through is just off the CFA Level 3 curriculum. It's a Lesson 12 in Private Wealth, and it is evaluating the success of your financial professional and the strategy they put forward. It has it broken down into 3 different areas, and I will go into much deeper detail in these 3 areas, try to make it as simple as possible to understand, like, here are the things that you can do to find out, are you doing a good job or aren't you? But the 3 areas are, number 1, goal achievement. Are we hitting the goals? Number 2, process consistency. Do I understand the process and how I'm working together with my financial professional? And 3rd is portfolio performance. They're managing the assets. Their objective is to grow those assets. What expectations can we have on their performance? Now, I'm going to go through a little bit deeper into a couple of things. One, as I have this as expectations, and there's 2 things. One thing is, if you're trying to work with someone, you want to have as clear as expectations on both ends as possible. From what I've experienced, when people are struggling and having a hard time working with their financial professional, is because they don't know what to expect from them, and then the financial professional maybe doesn't know what they're expecting. So you want to go through a clear definition of exactly what to expect in any different economic environment or whatever it might be. So setting those expectations is super important. The other really important thing is, when you're evaluating if you're successful or not, is I've heard from many people, I was like, well, I don't even know if the person's doing a good job or not, because I don't know how to evaluate it. That's why I'm going to dig deeper into each of these 3 things to make it as simple as possible. Like, this is the thing to look for to find out, yes, I feel very comfortable that everything we're doing is in line with my best interests and it's going to be helping me out. So I'm excited to go through these 3 things, and hopefully it sparks some questions in future videos. All right, let's go through the first one. That is goal achievement. Okay. I started off by just kind of thinking, what is a goal? And it's just, a goal is taking your money and using it to get what's going to give you the most life fulfillment. That's kind of the easiest way I can put it. And there's 3 different big bullet points to look at. The first one is, you need to have a balance between now and the future. And there's always going to be sacrifices earlier in your life. That's just the way it is. It takes time to build skills, to be able to advance in your career, to make more money, to save more money. It's just harder in some aspects early in your life. Now, I'm going to also bring up the point of something that I truly believe is that people will set a retirement date and say, you know what, I want to retire at age 64, 65, whatever it might be. I really believe of watching people develop in their careers and transition into what I would call partial retirements, the full retirements, is that retirement is an ongoing process, is that you continued as you're working within your career, get better and build up the skills, develop more freedom, not only freedom to be able to have time off, but freedom to do the types of jobs that you want to. Retirement to me is an ongoing process, and you kind of just keep working up to a point in your life that you maybe want to be 100% retired, meaning that you actually don't earn money, but you do exactly what you want to in life, or you could be still earning money, but just have a lot of freedom in your life. So that's at least a view I have on retirement. But when balancing between now and the future is that there has to be a list of prioritized goals. And I wrote down in quotations, say someone says, we got the house. Well, that might be one goal. So say they saved up a bunch of money to be able to buy a house. They got that goal done. That doesn't necessarily mean that they had a successful goal achievement process. You know, how does that work? Well, in the third bullet point, we're talking about you need to balance between your work, your savings, and your lifestyle. And I put down IPS. IPS is an investment policy statement. So when you're working with a financial professional, they're putting together that investment policy statement, and they need to know as deeply as they can how you're going to work and make money in your career goals, how you plan on saving that, and how that savings is going to balance with your lifestyle. So in the example of the house, say they got the house. Well, if they got the house and they now have to work way more hours and work way longer in their life, doing the things they don't want to do, they lost all their savings, so they have no cushion, and they don't get to live the lifestyle. So say they have other things that they really enjoy that they can't do because they don't have the finances to do it, then it wouldn't be like they achieved the goal. Is that you have to understand what do I want to do? How do I blend these three things together to give me my most satisfaction? So that's what goal achievement is, and that's how you need to prioritize. This is what's most important to me, and here's like something, if I can do it, great, but it isn't the highest level of priority now. Now, a way to understand how you're in line is, this is a CFA term, so I'll make it simple, but the CFA term is called capital sufficiency analysis. Something like that needs to be done by the financial professional to be able to say, yes, I understand your investment policy statement, these three things deeply, and from there I know you are sitting very good, and you can do, say you have 5 high priority goals, you can achieve all 5 high priority goals. And as that's going along, then say you take money out and you buy the house. Well, let's do another capital sufficiency analysis. How are we looking? Like, can we still do all the other things we want to do? And if the answer is yes, then great. We've now achieved the goal. And that's how you're going to evaluate. So the takeaway of how to actually find out, am I doing good in this or not? Number 1, do you have things prioritized? Number 2, do you have a good understanding of your now and future work, savings, and lifestyle, an investment policy statement? And then are you doing capital sufficiency analysis, just simply meaning, how are you doing? Yep, you can do everything you want to. The finances are looking good. So I would say that's kind of the more fun part of financial planning or investment strategies, is being able to use the money that you want to. If you're working with somebody that they want to see the same thing happen, they want to work with you, they want you to be able to get everything that you can do as far as hitting goals, be able to use the money they want to, give you fulfillment. So that's probably the funnest thing about working with individual in finance. So if that's all yes, then I would say objective met, and the goal achievement section is, you can say, yep, I don't feel anxious about this at all, and I think that we've done a good job. All right, on to the second one, and it's process and consistency. So this one's really, let's dig deeper into it. It is, is the financial professional being consistent with some of the core rules of finance and the communication that they have with you? So number 1 is, if there's been a investment strategy or philosophy that was agreed upon and understood, how consistent has that been? And if it's changed, like, was that addressed? Has it changed? Has it not changed? Do you just want to make sure that there's consistency with this strategy and philosophy? A second that the curriculum talks about is return versus cost. And I'll make this an easy example, is that, let's just say you have 2 investments, and one investment costs twice as much as the first investment. Well, there can be analysis done, like, well, is the fees worth it? And that's the job of any investment you have. You have to understand, what internal fees are there? And from those internal fees, is it worth the rate of return? Now, you could have two exactly the same investments. It doesn't happen too much in finance, but let's just say you have, they're exactly the same investment. The ETF, they hold exactly the same funds, and one costs more. Then the advisor needs to make sure that they're doing the right job when it comes to choosing the one with lower fees if you're dealing with a commodity, like a commodity type of investment. So you just got to make sure that return and costs are really examined deeply when making your investment choices. Taxes, that's one of the core areas of finances. Every time that there's a strategy that needs to be implemented, taxes should be taken in consideration. So when you're having conversations, are they talking about how this is going to affect me tax-wise? Is taxes, which can take a major drag on my finances, addressed with making decisions? This one probably should have been labeled first in the curriculum, but ongoing dialogue, probably one of the most important things, is just understand this is how and when we're going to be talking. So we can have a cadence where once a year is the appropriate amount of time to talk. It could be once a quarter. It could be we're going to talk once a quarter, but then anything that happens that's going to be life-changing, we've got to make sure that we address it and call and have a discussion about it. So it's just have a clear understanding of an ongoing dialogue that's consistent. And then another financial planning topic is estate plan and philanthropic objectives. So estate planning, taxes, all these things are core financial planning topics, and they should be addressed. And again, it's just when you are figuring out what level of dialogue and what level are we meeting, what level are we talking, what level are we communicating through written message, and has that been consistently kind of a known process during this whole time. So that's the way to evaluate it. If these things are being addressed, then that's probably the core areas that you want to focus on, and just got to make sure that time doesn't go by where they haven't been looked at or taken care of. All right, we are talking about portfolio performance as the third thing to have expectations and also evaluating whether your strategy is successful or not. All right, so this one actually, even though maybe a little bit more complex with all the different moving parts, it can be pretty easy because you can compare, this is my money that I have in my account versus where it should be. And the first comparison tool is what are called benchmarks. And a benchmark can be, say, an index could be a benchmark, blended index could be a benchmark, and some of these terms maybe you're not familiar with. I'm going to try keeping this as simple as possible. Let's just say you have a 401k. And in a 401k, there could be a choice that would be a retirement fund or a retirement date fund. That retirement date fund might be 2060. So that means that if you're going to retire in the year 2060, you can theoretically put your money in there and it's going to be the best investment, and all your money goes in that retirement date fund. So you have one fund that's very easy to track, very easy to be able to look up to see how it's doing. Now you have something to compare to. So if you say, well, I'm not going to put my money in the retirement date fund, I'd like to have a diversified portfolio with different types of investments that leads to my goals, then you're going to be putting money into a different account, but it's going to maybe still have that same long-term strategy. If you want to compare how you're doing, then separate your long-term investments and say, okay, how much better are my investments doing than the retirement date fund? So that's an easy way to think about setting an appropriate benchmark. And I'm going to really stress how important it is to set an appropriate benchmark. And maybe I'll talk a little bit about this when I'm talking about some of the behavioral biases and upside and downside. But it is very important because you don't want to be comparing to the wrong thing. It can get you in trouble. Second is I'm referencing long-term investments and investment strategy. So if you can easily divide your investments into long and short-term, and how do you want to compare? Well, short-term investments, really an investment that has risk, meaning it can drop in value like a stock, are not appropriate investments for short-term investments. If you are saving money, you know you need $50,000 in the next 6 months or the next year, you want to have that safe. So the thing to compare your safe money to would be, what's the risk-free rate of return? Let's just say the risk-free rate of return is 4%. Well, go get the 4%. It doesn't have a downside, it has that downside risk if you need the money. As long as it's like the duration is matching, the time period. So if you have, say, a 6-month CD and you need the money in 6 months, if those two time periods align, then you know you're getting your, say, 4% in the example. So that's what you're comparing to. So if you're comparing to investments that are long-term, like the benchmarking strategy, then now we can look at maybe how can we compare this to another investment that's going to have a certain up and down risk to it, but it's going to be the right investment to compare it to. I also take a note that there can be different investment strategies. And so you want to be on the same page, like this investment strategy is going to perform well in the long run, but there might be different times during the economic cycle that it could be up higher or lower than maybe the benchmark. So it's just to be on the same page with understanding, here's what we're doing. This is how much money we need to have in short-term money. We're getting the risk-free. This is how much money we have long-term money and what we can expect and what's an appropriate thing to compare it to. Now, you also need to get into a bigger understanding on any investments you have has a certain level of upside potential and downside risk. So I reference, say, a Vanguard 2060 fund or a Fidelity 2060 fund. That's a retirement fund, but it's publicly traded stock. And it's usually big companies that have proven themselves. That type of investment is going to be far different than, say, a private equity investment or a venture capital investment or an angel investment, something like that could have a tremendous risk. So those, like an angel investment, you could lose all your money. Should not be compared as the same thing as the stock market. Now, what I will see oftentimes, and this is a behavioral bias that you got to be really careful about, is someone will say, well, I'm going to invest in this private investment because it does so much better than the stock market. Or they maybe say, well, I'm going to invest in the stock market because it's so much better than the risk-free investment. Or they might be looking at a previous year, it's like, well, risk-free did the best, so I think I should invest in risk-free because they're just looking at one period of time. You got to make sure you're understanding the time periods, when it's most appropriate to evaluate, and then what's the upside, what's the downside. Because I've had this happen many times before. Well, a person will take a look like, well, during this 3-month period of time, this investment did better. Don't you think this is the right investment? That's only 3 months. Any investment can be the best investment in a 3-month period of time. You got to be thinking like, okay, long term, this is what our expectations are, and this is how we're going to track it. I'm going to give a couple of more examples on investment strategy in my next video, but hopefully this kind of puts things in perspective. It is the easiest one because you can just look, how much money do I have in my paper, and how much would have I had in how much money do I have in my retirement fund, and how much would have I had if I did the Vanguard 2060 fund. So that's the easy thing about it, but there is a lot of moving parts that should be discussed. All right, I'm going to dive a little bit deeper into the portfolio performance, and I'm going to give some unique examples on investment strategies and how to set expectations during different time periods. So I'm going to use a very common investment strategy, at least among professional investors, and that is intrinsic value philosophy. And what that means is you're putting some thought into the true company itself, how good the company is, and then the price that you're paying for that company, whether you should be holding the investment, whether you should sell some at sometimes. It's not just holding the whole market and then just holding it for the long term. There is decisions that are being made based upon how valuable to think the company is. So you're looking at the company's intrinsic value and determining, should I buy, sell, or hold? Now, the reason that you would do that, first off, is that it does put a margin of safety. As if you've seen a stock run up, and now it's really high priced, you don't necessarily understand why it's at that price. It has certainly a downside risk. Every stock has a downside risk that can't continue forever. I've talked about that before. The rule of finance is that growth of price that's much higher than growth of company can't continue forever. So you have a margin of safety, meaning that if you have a 40% drop, if you had sold that stock, then you're not going to have that 40% stock. So you understand how much safety is in your stocks. The second is that long-term investment outperformance is, of course, a goal. Is that if you're looking at avoiding, say, the big stock market drops and having that margin of safety, many of the most successful investors were able to outperform the markets because of that. And I'm going to illustrate what I mean here just with a business cycle and the expectations and the different stages of the business cycle. Now this will be kind of just going through the philosophy of it, but I'm going to give an example. Say it's now 2009, and we were at the bottom of the financial crisis. S&P 500 was at its lowest level in quite a while. It had hit what would be considered the bottom of the trough. And once it now made a turning point, and it started early expansion. Now, at this time, in the very start of the early expansion, there was a lot of very good companies at super low stock prices. So the intrinsic value philosophy is going to do really well during that time, because you now are able to get awesome companies at a very low level. Now, the overall broad stock market is going to do well, but if someone's really good at understanding the intrinsic value, they should be outperforming the market at that time because of such good deals that they're getting. Now, as the market continues to climb, you have from early expansion to late expansion, and the growth starts to slow. At this particular time, from early expansion to late expansion to the very top of the market, when it's getting later in the stages, the intrinsic value investor is going to be looking deeper at, okay, how far have these stocks run? Should I take some off the table? And during this period of time, you probably aren't going to outperform the money or outperform the market. Many of the professionals that I reference that use this, they get criticized very badly. In the dot-com bubble, many of the best investors were criticized, like, why aren't you buying all this tech stock? It keeps on going up. They knew that some of the companies were so overvalued, but they just didn't know like when they were going to drop, because that it's impossible to know when this turning point is going to happen. And you want to, but it's some element the intrinsic value investor is going to be trying to put back, what I said before, that margin of safety. So let's just say now it's underperformed a little bit, but it's hit the peak at some point, and then from the peak, it goes from contraction to the very bottom again. And then during this period of time, from peak to trough, is where that investment strategy is going to do very well. So if you're setting expectations and you're like, why hasn't my investments done as well? Maybe it was, let's take a look at where we are in the business cycle. It's like if we're in the late expansion to the peak and you're using some element of margin of safety and understanding like this is how high or how overvalued you are, you're not going to quite do as well. If you're looking at early expansions, okay, what can we get to get in those good deals? And then when we're going from peak to trough, that's probably the most common time that this style of investor is going to outperform the market, because if the market's dropping by, say, like in 2000, from 2007 to 2009, to drop almost 50%. So if the market's dropped from peak to trough by 50% or 40%, 30%, the intrinsic value investor has moved from stock over to bonds, and it's not going to have that same level of fit. So my point of this was to illustrate there can be different time periods that you have different expectations, and it's good to understand, talk to the financial professional, like, hey, what do you think? What time period are we in? What's going on? And what can we expect? And they can never expect knowing the turning points of this, but they can kind of expect this is what we can see. And we've had 17 other business cycles that we can model after, and we'll just learn from the history and also learn from the true value of the companies. All right, we are on to the third part of choosing a financial professional, and we are using ChatGPT as the tool today. Now, I will say that ChatGPT, I use it quite often. I think it's awesome, but it's obviously only as good as the questions you put in, and it doesn't give you nearly the same level of step-by-step process as, say, the ACQ AI that I'd gone through earlier. But let's just go through what it says. First up, 4 questions that you can ask. First thing is you just state, this is who I am. So if you're a business owner, if you're a retiree, if you're a person with stock options, whatever you are, this is who I am, and this is what I need help with. What I need help with, you could just simply say, I need help with my wealth, I need help with my taxes, or I need help with my business, or I need help with all 3. So who I am, what I need help with, first thing to type in. Second thing is ask for description on, can you tell me a little bit more about different titles and designations? So you have to have some sort of starting point on what does the financial professional do, that maybe if I got reached out by a financial professional, the reason I started this whole video is because of the colleague that says people on LinkedIn are reaching out to me all the time, but I can't tell one difference between one and the other. So let's just see the designation or title that they have. And then it did a very good job of describing all those different designations and titles. You can just ask for a little bit deeper. A common three are CFP, CPA, CFA when it comes to wealth, taxes, and business. So just ask, can you give me more detail on each of these three? And it goes into pretty deep detail. And I will say that what comes up is pretty accurate on what those designations have specialties in. And then it also had kind of gone into, if the professional has multiple designations, this is what you can expect. I didn't ask this question, but another question you could ask is just how difficult the designation is. I know there's designations that I've actually done these designations in the past that only take 2 weeks to complete. And then there's designations that take multiple years and really rigorously and challenging to be able to complete. So you can ask that too, just all right, here's a designation that I see. ChatGPT, tell me how difficult it is to get this designation, and then what skills does the person that got that designation have, and is it going to correlate to what I need? So that's first step, ask the right questions. I'm going to break down a little bit on what those answers were that ChatGPT gave me. So number one is it does give a pretty good meaning of the common designations. So it just said, here are the common designations, and here's what each of them means. Second, it says, without very much detail, it's ideal for you in your wealth, taxes, or business. So it basically went through those three areas and said, this is what you should be looking for in each of these three areas. And how do we evaluate? So the evaluation process is very similar to all three areas. And that is, please give me examples of who you've worked with, how you get paid. Can you give me references on the people that you worked with? And the last thing I said was a fiduciary. I know that word maybe gets thrown around a lot. A lot of times if you have a designation, you have an automatic fiduciary. So I don't want to get too much deep into that, but it did say, ask if you're a fiduciary. With my designations, have a fiduciary. Many people are, but it's important to ask that, I guess. So and then the fourth one, it goes through each of the designations and says, this is what makes this person valuable, and here's what the limitations may or may not be. So it's not a perfect solution, but it does cover pretty good, I think, with what makes them valuable and what gives them limitations. And then the last one goes through, is like, this is where it's going to be a good fit, and this is where it's maybe not going to be a good fit. I thought it did a really good job explaining, here's how each of these stack up as just one single designation. Here's how they can combine them together. Either you're using multiple people to get everything done, or you're using one person that can be more of holistic help. It depends upon the state of your career, the state of your business, what you can afford, what makes financial sense to use. But overall, ChatGPT did a pretty good job. I just kind of gave a basic framework and a good educational source to be able to understand this is what skills that person should have. So hopefully this is helpful, but go out, test it out, ask questions, and just keep on getting hopefully good answers.